Now, I love a well-groomed, clean Chesapeake Bay, and some people love fancy-sounding names. One fancy-sounding name we keep coming across in the life insurance industry is High Early Cash Value Dividend Life Insurance, also known as HEC-V. And to understand HEC-V life insurance, you first have to know how financial companies credit interest to life insurance policyholders. First method is pretty easy to understand. It's guaranteed. There is a guaranteed rate of return that company is offering on your cash value, and it's usually a smaller rate. Next is the exact opposite, called a variable crediting method. This is where your interest credited to your cash value is based on an investment in a stock or bond. And then you've got the more and more popular indexing crediting method. This is where you have a window of possible return, so a very small floor guarantee, and you're not directly invested in any stock or bond, but your interest credited is based on how the major stock indices perform. Now, High Early Cash Value Dividend Life Insurance is a normal guaranteed whole life policy that allows you to also at the end of the year enjoy the company's profits. This is because many of the large financial companies do not actually have shareholders. These are known as mutual companies like New York Life or Mass Mutual. So in effect, the clients that purchase their financial products are the shareholders to that company. So when the company at the end of the year does better than expected, they give their clients a piece of those profits known as dividends. Now, High Early Cash Value Dividend Life Insurance is very similar to increasing universal life insurance. Both policies start you out at a minimum death benefit with a maximum contribution in premium. This is so that most of your premium goes into the cash value account to be credited the interest. So over time, you're actually insured for more and more. But the difference between the two is how that excess interest is actually credited. In a High Early Cash Value Dividend plan, you are only going to receive that dividend if the company did better than expected. Now, many of these large financial companies have been around longer than our oldest banks, so their growth and security is very strong. So these companies not only offer a higher guaranteed interest rate on your policy, but because of their strength and seniority in the market, they're also highly likely to be issuing dividends at the end of each year. Whereas index and universal life insurance plans are based on how the stock market performs, which we know can be much more variable, and in the latter can actually lose money. But these policies offer a larger potential to gain more money, meaning although the guarantee plus dividend payments for mutual companies are almost a lock, in a really strong economy, your cash value accumulation would not be as high as if you were in a universal life plan. And of course, the opposite is true as well. In a weak economy, the High Early Cash Value Dividend would probably do better. So whether or not you prefer any life insurance policy over the other is always going to depend on your taste for risk and why you need the coverage in the first place. And that's why working with a knowledgeable insurance advisor is so crucial.